Hey everyone, welcome to yet another segment of Market Views. Today we're going to look at how our markets performed for the week ending 7 November, which is the previous Friday. And as we go through the review, we'll also look at October's highlights, draw on October's highlights for context purposes, the movers, the shakers, and the stories behind the numbers. So do stick around as we break down what stood out and what could be next. Right, let's dive straight into it, shall we? The ZSE All-Share Index slipped by 95 basis points over the week, while the VFX All-Share Index climbed 204 basis points. This follows a positive October performance for both exchanges, whereby the ZSE advanced by 1.45%, recovering from a 24 basis points dip in September. The VFX extended its rally with a 6% gain, building on September's impressive 21% surge. Looking at both the weekly and the monthly review, it's been gains and gains on the VFX, while the ZSE continues to swing between the patches of the red and the green. Market activity strengthened across both exchanges during the week. On the ZSE, turnover jumped to 88 million ZiG, up sharply from 24 million, which was recorded in the previous week. While on the VFX, turnover climbed to 1.7 million from 686,000. That's a solid start to November right there, especially after a quieter October, when activity slowed on both our exchanges. In October, turnover on the ZSE fell by 14% to 391 million ZiG from 454 million ZiG in September. While on the VFX, it saw a 20% dip down to 6.8 million from 8.5 million. Now, looking at our exchange rate framework, both the interbank and the parallel exchange rate remained stable throughout the week. But in October, we saw the interbank rate strengthening by 97 basis points, even as the parallel rate market premium continuing to hover around the 32-35 range. Delta once again dominated trading on the ZSE, accounting for 83% of total weekly turnover, followed by Econet at 11%, with the remaining 6% spread across all other counters. The same trend was evident in October, when Delta and Econet contributed 46% and 25% of monthly turnover respectively. In September, the two led the board as well, with Delta accounting for 8% and Econet 40%, reaffirming their constant dominance on the local bourse. On the VFX, Insco topped the weekly turnover chart, contributing a significant 87% of total trades. In October, trading was again concentrated in Insco and Padenga, which accounted 55% and 22% of monthly turnover. Similarly, in September, Insco also led in activity, roughly around 69% of total trades, clearly signaling a sustained trend of large transactions in the counter. Foreign participation on the ZSE showed mixed movement during the week. Foreign purchases declined, while foreign sales soared to 59 million ZiG from just 5,000 ZiG previously. On the VFX, both foreign purchases and sales increased, with sales notably exceeding purchases. Considering that foreign activity on the VFX has eased in October, the recent spike in net sales likely reflects some investors taking profits, possibly anticipating that the strong rally may be approaching a period of consolidation. Back in October, foreign purchases on the ZSE had jumped from 1.2 million to 11.6 million ZiG, while foreign sales rose from 95 million to 174 million. The latest trend, a pullback in purchases and a sharp rise in sales that we have witnessed over the week, it suggests that most of the last week's trading activity on the ZSE was driven primarily by domestic investors. On the ZSE, 15 counters ended the week in the green, while 16 closed lower. ZB Financial Holdings emerged as the top gainer, whereas Ariston led the losers. Delta inched up by 26 basis points, maintaining its fairly upward trajectory, while Econet slipped by 7.65%, finishing the week in the red. For context purposes, both Econet and Delta were among October's top 10 gainers, rising by 13% and 11% respectively. So this week's performance, however, highlights that Econet's share price is somehow volatile compared to Delta, which is more defensive. The VFX posted 6 gainers against 4 losers over the week. Caledonia topped the gainers list, while Edgar's led the laggards. Padenga, Kavango Resources, and Insco also ended the week in the red, albeit those losses were relatively modest. In October, Caledonia led the movers, gaining by 30%. Therefore, the week's additional 20% rise that we have witnessed further extends its positive momentum. Kavango Resources trailed closely behind Caledonia in October, and Padenga also recorded significant gains over the month, suggesting that this week's slight pullbacks could reflect price corrections. Insco eased by 47 basis points over the week, following a 2.88 decline in October, which partially offset the 3.66 gain which was recorded in September. The counter continues to trade within a narrow range or a narrow band, given its 62% rally in the quarter ending September. So therefore, the recent mild losses appears largely marginal and consolidative rather than trend reversing. Following Econet's 13% and Delta's 11% gain in October, both of these counters saw their market cap rising notably over the month of October, and by end of October, they collectively accounted for 55% of the ZSE total market cap. And as of the latest weekly review that we've just done for the week ending 7 November, after their mixed performances, they now make up about 54% of the local boss market cap. In October, FML was replaced by Hippo in the top 10 counters by market cap. And as of this latest review, Hippo continues to hold its place in the top tier, while FML has slipped to the 13th position. Over onto the VFX, Padenga overtook Insco on the top spot in October, and it continues to maintain that leading position. Meanwhile, counters such as African Sun lost its steam for the past 3 months in a row, month after month, row by row, and it was replaced by Exia in the 7th place, a shift that remains unchanged following this week's review. Here is our outlook for the week and for the month of November. On the ZSE, we expect Econet and Delta to remain the primary drivers of market activity, as these counters continue to alternate between the first and the second position in terms of turnover. However, with Delta set to release its half-year financials for the period ending September for the full year ending March 2026, Delta is likely to host its analyst briefing this Wednesday. So therefore, we expect this counter to take the lead in terms of the turnover board. Econet is likely to remain a bit volatile, while Delta is expected to continue exhibiting its defensive characteristics, at least working with the information that we currently have now. On the VFX, some volatility is likely to ensue, with mixed performances across counters likely to take place. As seen in October, counters such as Insco experienced modest retracements, while in the last week's review, stocks like Padenga and Kavango showed signs of losing momentum. Well, that's all that we have for you on this first segment. Catch you on the other side. Stock Exchange, as well as the Victoria Falls Stock Exchange. We explore them and share our analyst views. But today, before we dive into it, here is a quick update. NTS released its circular to shareholders for its proposed delisting on the Zimbabwe Stock Exchange. So it set the extraordinary general meeting for the 19th of November, where minority shareholders are supposed to vote on the delisting, accompanying the offer made by Radan Investments and Ukatil Holdings, which collectively owns 62.77% in NTS. Should it be the case that the minority stakeholders approve, the delisting is set for the 31st of December in 2025. And some of the reasons that were alluded to its delisting are issues to do with liquidity. Can you think of it? If you are to look from the year ending just looking at a year-on-year review, and in July 2025, NTS did not trade on the Zimbabwe Stock Exchange for 8 out of 12 months. So those are some of the reasons that they are actually alluding to right there. And of course, some of the issues to do with high costs of maintaining it a public listing. And as of 2025, some of the counters that have delisted on the Zimbabwe Stock Exchange, there are 3 counters. We saw in January the Old Mutual Top 10 ETF delisting, and in April Kaya delisted, and in July Truworth delisted, and now coming NTS. But well, perhaps this can be a topic for another day. Let's dive into our today's topic. We're going to unpack Afdis half-year financials for the period ending September 2025, as well as look at BAT's half-year financials for the period ending 30 June 2025. We just thought perhaps it's one of the counters that we have left behind, and we want to look at it and share with you some of our views. So joining me today on set is my fellow analyst, Ian Banda. Help me to welcome him on set. Ian, welcome on set.
Yeah, thank you. Good. It's a pleasure to be here.
Yes, it's a pleasure having you as well. Now, let's dive straight into it. Let's look at Afdis, which is a subsidiary of Delta, right? It recorded a surge in its top line. That's, 43% volumes across its segments. And when you look at Afdis, its model, it has got 3 main segments. That's the wines, the ready-to-drink, and the spirits. The wines, the volumes grew by 59%, the ready-to-drink by 47%, and then the spirits by 36%.
Yes.
And this resulted in the surge in the top line by 54%, around 40.4 million USD. Now, let's unpack this. What key factors might have likely contributed to this growth?
So it tells you that there was a period of economic stability, with also inflation being around marginable numbers. Then also looking at gold was at an all-time high. It broke the record, I think, three times during that period from March to September. So Zimbabwe is a huge mining country, especially for gold. Gold has been one of our top forex earners as a nation. Then we also had a good harvest, the good tobacco season. A lot of farmers were really grateful for the good prices they received. So everything was pretty okay macroeconomically. So I think those points caused sustainable consumer demand.
Okay.
So that resulted in Afdis recording a 54% rise in volumes and 43% rise in volumes, which resulted in around a 54% rise in revenue growth. Yes.
As we cascade down the income statement, we also saw that even operating income surged, but it's surged by an astronomical figure. That's 280% to 5 million from around 1.something million. So what drove this bullish bottom line performance? Could it be an issue to do with cost savings, or we can attribute it the same to the robust performance in the top line?
I think this is attributed to the robust performance of the top line. So before we get to operating income, we can notice that revenue is a factor of 2 components. It's a factor of price and volumes. So we notice that volume is increased by 43%. And Afdis also managed to maintain a good pricing strategy, resulting in that rise in revenue. Then we get a good gross profit margin. Going down, the costs are increased. The production costs, your admin costs. So we can actually notice that the operating income was a result of the interplay between price and revenue, rather than cost curtailment measures.
No, thank you for that update. Now, looking at the beverage segment, like I've alluded, as we were studying the segment, that Afdis is a subsidiary of Delta. I actually saw, and I'm sure you also came across it, that Varun Beverage is likely now to enter into the alcohol space through its Carlsberg beer. So just looking at the competitive landscape evolving in the Zimbabwean beverage market, how is Afdis positioned? Do you foresee it holding fit on its market share, or any particular changes likely to take place?
My view is that Afdis has been seeing significant competition from the informal sector mainly. But government's efforts to actually curtail smuggling and also deal with imports of cheaper liquor and wines coming through our borders without paying the requisite duties has been commendable to the increase in volumes for Afdis, because the authorities have put a tighter grip on illicit brewing and also smuggling of wines from around our neighbors. Formerly, Afdis has held a very significant market share. I don't think the introduction of competition from foreign beverages coming into play will be a major factor. The informal sector has been the real problem for Afdis, because we have seen that there's a lot of illicit brews of spirits, especially spirits with the tukumbwa and all that, and others actually also taking their the Afdis labels and just putting their illicit brews and not selling the real product from Afdis. That has been a problem, especially in the urban areas like Mbare and so forth. But with the authorities actually interacting with Afdis and helping each other to curtail and also the campaigns against people drinking illicit beer or illicit spirits, it has made the volumes increase. So going into the future, I think competitively, Afdis in the formal market will be the dominant player. But we want to see the measures being implemented by government against illicit spirits and also cheap wines coming from our neighboring countries. If that is controlled and they take a firm grip on that aspect,
making sure that our borders are not porous.
Are not porous, exactly. It will protect Afdis, and Afdis market share will actually grow.
Okay. So just the company's outlook going forward, any particular changes as far as the top line and the bottom line is concerned, or we are likely just to see the same trend, whereby the full year financials are recording a surge in the revenue as well as the surge in the bottom line?
With the current economic stability that we are experiencing and the promising good agricultural season, I think we'll see an increase in the top line. But I'm worried about the cost of goods sold and the cost of the admin costs, because we have seen that companies manage to record huge revenue growth, huge volume increase, but the cost curtailment has been a problem as you try. But I think with the economic stability coming into place, there will be few issues whereby you need to pay your employees more in USD, but that depends also on your revenue mix. And also the problem with electricity and water supply that has caused a lot of companies costs to run, especially for Afdis, because they use a lot of water in their processes, and they need also a lot of electricity. But we have been getting around 12 8-hour power cuts, with them having to resort to using generators or auxiliary power from solar. Then water, they have to either you buy bulk supply from third parties, or you drill balls. Those balls also run on electrical power. So that has been a major cost driver. But if we can see the local authority being able to provide good raw water, I think we will see their revenues increasing, because the cost of production lowers. And if there is also, I think it was a welcome remark by Zera, which encouraged third parties to also produce electricity.
Exactly.
So it's either they can decide to have their own power plant, or they can have a third party willing to offer them power at affordable.
So they know it's coming at a consistent
you need consistent basis, and also at an affordable prices, in order for them to actually protect their margins.
Yeah, we'll see how that turns up. As we round up on Afdis, any particular key performance indicators that you think Afdis can possibly should look at, even as we are ongoing, taking into account our current operating environment? I mean, I'm sure you've also addressed the issue to do with electricity. I mean, is there anything else, or maybe if we don't have, we can then move on to...
I think then your normal KPIs, you need to look at your revenue growth, your volume growth. So volume will actually tell you if there is sustained demand for your product. So if you see your volume is increasing, it means that you're actually doing all the sustained demand for your product. Then also, I think they'll have to look at the cost of goods sold, like I alluded to, their cost of raw materials. They have also to monitor your macroeconomic indicators. Where is inflation going? And also the exchange rate. We have seen that the exchange rate has been a huge factor impacting the revenues for most companies. But now you also have to look at the interplay in the market in terms of liquidity. Is there more of ZiG? Is there more of US dollar? And many companies are really interested in earning a lot of hard currency. So they'll always monitor the composition of the money supply which is in the market. I think those are relative key indicators, and also following up on which sectors are performing well. So if we have a good harvest, you need to push more of your product into the farming areas. If gold prices maintains its momentum, which it currently have, you need also to move a lot of your product in the mining towns, near the Amakorokos and people like that. So you need to actually curate your route to market towards
attracting those
informal sectors. Yes.
Interesting. Let's move to BAT. Right. We saw the top line of BAT declining by 28%, and largely due to a reduction in volumes. Like we have been saying, that performance on the top line is a composition of either price or volume. Volumes declined by 14%. But another interesting highlight that we can look at, when we look at the segmented revenue, ideally in the domestic market and the export market, we actually see a decline in the revenue from the forex market, right? Revenue declined by 28% to 13 million. And from that 13 million, around 12.9 million of it is from the domestic market. And in the export market, we actually saw revenue declining from 3 million, which was recorded in the previous half year, to only around 120,000. So let's start from there. Maybe perhaps just making your commentary on the performance of the top line, and also, I mean, sharing your views. Isn't it worrisome that we are witnessing a decline in the forex market? Is it sustainable? Any particular risk for it to depend perhaps on the revenue in the domestic market?
Okay, thank you, Kuda. So looking at the decline of the export market, it is my view that it's a result of either two things. We saw that their cost of goods ballooned, and the increase in their cost of goods also meant that they had to pass on that cost to the customer. So in the export market, you realize that your customers are very reactive to price. So it's my belief that in the export market, their goods became uncompetitive. Then the second factor would be that demand in the local market might have increased, so they had to actually first fulfill the demand in the local market that reduced the products that is available for export. That's my view for that. Then a decline in revenue and volumes. This is a full year result. So there are macroeconomic factors coming in from 2024, where we had exchange rate volatility, low liquidity, there wasn't enough money circulating in the economy, and our agricultural sector was still recovering from the El Nino effect. So that curtailed the demand for the product, and the decline in revenue and volumes. But I think if we are going to look at 2025, 2026 financial year, I think their fortunes are going to turn around.
Okay. Yeah. Okay, interesting. On that same aspect that you touched on, the issue of costs, you saw that the cost of sales, they rose by 31%, likely due to an increase in raw material prices. But in the chairman's statement, we saw that they mentioned something to do with a specific strategic action that they are likely to take place in order to offset the rising input costs, as well as resuscitate perhaps the constrained consumer incomes demand. Is it one of the things that you're possibly highlighting, that perhaps in the full year financials we're likely to see a rebound, largely due to some of the sectors that have performed well?
Yes, I think the chairman is correct to put those strategies in place, and I think those will yield good results in the 2025 full financial year, because they're talking of actually putting on a pricing strategy that caters for the lower end of the consumer segment and also the middle income people. So I think that is going to yield good results, and also they are looking at cost cutting measures. So I would like to believe that they will try to source more of their raw materials locally. Well, we have a good tobacco farming industry, so I think that will help them. And also I think looking at the cost of production, like I said, you have your electricity bill and all that. If they manage to reduce that, it will help them protect their margins.
Okay. Now as we round up on BAT, in as much as the counter experienced a knock in its top line, we saw it recording actually a profit of 6.6 million for the half-year period. And if we are to compare with the previous half-year period, Mike, we saw it actually recovered from a loss of 10.6 million. So looking at this increase in the bottom line, what drove it? Is it likely the issue of the absence of the 15.8 million that we saw that was in the prior half-year mark on the hyperinflation era, or an issue to do with perhaps cost containment or anything else?
Oh, so that is actually in a technical improvement. Okay. It's an improvement due to accounting. So the absence of the 15.8 million hyperinflationary loss, monetary loss, exactly, it's what resulted in the 6 million profit. Because if you look at the interplay between that, revenue decreased, volumes decreased. So you see that there are still pressures on the company's top line. If we factor in that loss, the company's bottom line will remain in the negative territory. So this is just a result of that technicality in terms of accounting. But I would want to believe that the company's fortunes can turn around soon.
Interesting. Ian, thank you so much for sharing your valuable insights. It was quite an insightful episode, and I do wish to have you on another session.
Thank you, Kuda. It was such a pleasure being here.
Absolutely. And our guests and our audience, thank you so much for tuning in. It has been a delight having you on set. And well, just for your information, be on the lookout for Delta's half-year financials for the period ending September. Right, and as we are also going to attend its analyst briefing, which is there on this Wednesday, be on the lookout for that. Thank you for tuning in. Until next time, keep your eyes on the market.